You don't want to miss this episode. We're going to dig into the participating whole life fund. How has it paid a dividend for 150 years? What do they invest in? Let's get into it. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell, and joining me as always, Christina White. Christina, how you doing today?
Hey, Darren, I am doing awesome. Excited to talk about this topic. I'm excited to dive into it. I think it's going to be a good one.
Yeah, people are always asking us, like, what is this? How do they get these magical returns? So today we're going to dig into participating whole life and how they invest those funds.
Exactly. But before we jump in, I just want to remind everybody, if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. And if you're listening or watching on YouTube, please subscribe and like and hit that bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on Instagram and TikTok.
Great. Okay. What is participating whole life insurance? Think of it. Premiums come in, that money gets invested, and then money goes out to pay death claims. But that money gets invested and they pay dividends. And those dividends go back to the policyholders, the owner of the fund, to grow their cash value and grow their death benefit. And the four companies we deal with have never missed a dividend since inception, going back 100 years for the newest or 150 years or more for the oldest. Money comes in, gets invested, death claims pay out, but every year there's a dividend paid since inception, go back to 1867. That's participating whole life insurance. So when we dig into how do they invest that money, well, it comes from a combination of there's guarantees in there, plus there's investments. And again, the four companies we work with have never missed a dividend, but it's based upon more than just investment returns. They also look at mortality. How often are people dying? Are people living longer? Are people living shorter? Cancellations, huge windfall for us as policyholders. When other people deal with other advisors with a poorly designed policy, they put money in and cancel in a few years. Well, all that money they've paid in and the little bit they get back if it wasn't designed with us or wasn't designed properly, that money stays in the fund. So it benefits all the rest of us. Taxes are a big one, how they limit the taxes. So we're going to dig into all that today, but these funds we're talking about, they're huge. The smallest one would be about a little over $1 billion, but the largest is over $50 billion. So massive pools of money that are invested, been doing it 150 years or more, incredible track records. So we're really going to dig into Christina, sort of how do they have these amazing track records? What do they invest in? What's the asset mix, et cetera. So let's dig into it.
Yeah, I think it's a great question from clients and individuals that want to get into, the participating whole life and use the infinite banking concept. It's like to know the underlying investments, what's actually happening inside of there. And the investment component, yes, it's one piece that makes up the dividend, but it is a pretty big piece, right? So to look at where those returns are coming from when they're deciding the dividend is important. So we're kind of going to do an overview, not dig into individual funds, but we're kind of talking about the four companies that we work with, right? The ones that have they kind of check all the boxes for us to be working with them. They've got over $1 billion. They've got, they've been around 100 years plus. And they've always paid that dividend, just like you said. So we want to make sure that we are working with those companies. We're going to kind of look at those and their asset mix and their breakdown. And they are going to be very similar. So we're not seeing anything completely wonky from one to the other. Very similar when we look at the breakdown. So a typical participating fund is going to be made up of a few different assets. So you've got your fixed income component. So you're looking at public and private bonds. You're going to have your equities component, which are, again, going to be public and private. You're going to have real estate investments in there. You're going to have mortgages, cash or cash equivalents. Some of them will have. And then you've got private debt or policy loans that we talk about. So that's the mix of what they are invested in. We are going to dig a little bit deeper because some of the companies do have different underlying assets in their mix, but every single one of those power funds is going to have a makeup of these components. Like these assets are going to be made up in that participating fund.
So let's dig into those the asset mix. But I always love doing annual reviews with clients. It's like, we call this boring but super effective, right? It's just like there's no surprises every year. It's like, oh, the dividend stayed the same or went up slightly. Like I did a review earlier this week, and it was like, well, what's changed since we last chatted? Well, your dividend went from 6.1 to 6.35, but other than that, everything's working out exactly as we had planned, and that's huge to have that just that rock solid bulletproof part of your portfolio.
Well, yeah, because I want to add something in there too, Darren, when you mentioned that. It's just that these investments are happening in that fund all year long. They're invested, but that dividend's only getting declared once a year. Once it's done, right? That's what makes it boring. It's pretty boring. You get it one time a year, and that's it. So you're not watching these investments every day to see what they're doing. You get your dividend announcement once a year, and that's that.
Yeah, it's like if you wanted to check on your cash value balance every single day, well, all I can tell you is what it'll be tomorrow is higher than today, guaranteed, because it goes up in value every single day throughout the year on a fully guaranteed basis, which is pretty cool. So we dig back into the breakdown of those assets you went through. So I want to talk about one specific company, but again, they're all within a few percentage points of this. So we've got bonds, public bonds at 33%. Real estate at 18%. We can dig into more about what the actual real estate is. Public and private equities, stock market stuff, they have around 25%. Mortgages, these would be mortgages they would loan out to individuals, corporations, businesses, 19%. Private lending or private debt, 5%. So again, we've got a fair amount in bonds, real estate, equities, mortgages, and some in private lending or private debt. And again, all these companies are going to have slight variations of the different one, but they don't, they never sway too much, do they, Christina?
No, all of the companies kind of have targets on what kind of swing they can have in each of these categories. So in talking about the fund that you were just kind of reviewing for their public bonds, they're really not going to go outside 26 to 50%. They can't. They have a target investment guideline where they're not going to go outside of that. Same with their real estate and their equities. They're not going to be more than 32 to 48% invested in those areas. And then for their mortgages, their private debt, private lending, they're not going to be any more than 18 to 26%. So yes, they do shift, and they do shift annually. When they're looking at it, they're shifting them, but they have to stay within these target guidelines, because when they're doing these investments and they're choosing them, they're looking at the long term, right? We're talking people live in 30, 50, 100 years when you're putting a kid in one of these policies, right? So they're looking at it for the long term. It's all going to be looked at very conservatively, and they're going to make sure that they have those long-term conservative returns. So they have to stick within their target guidelines, that was kind of the breakdown of where we have it. So we can see that they're, kind of in the middle, like working within those guidelines right now with the breakdown that they have overall.
Yeah, and it's obviously you want the fund managers to have a little discretion to say, oh well, we think this is a better opportunity to get a higher rate of return this year. We'll shift some more or some additional money over here, but we don't. It's not designed to be a crazy high risk investment. Is the lowest risk investment ever. But I love what he said about long term, because you think of a fund manager. Well, they need to make next quarter's number to hit their bonuses targeted to keep all those investors happy, versus when you look at these whole life funds, they're looking at, okay, we need to pay a death claim in 70 years on this 30-year-old or 20-year-old. We can invest that money super long-term, and then that long-term emphasis on return in the long run is going to work out, instead of that need to fix that short-term quarterly returns. And then, not to mention growing tax-free is a million times better than growing taxable. So if we look at the bonds, we break down these assets a little bit. The bonds, they've got Government of Canada bonds here, pretty safe. They got corporate bonds. There's a real mix of AAA, AA, single A, and triple B bonds. So they have a mix of bonds. If you look at their their bonds out there right now, on average, they've got about a little over 20% in 0 to 5 years and 80% over 5 years. Okay. So again, they're holding these bonds to maturity. So sometimes there's a risk in bonds. If you buy a bond that's paying 3%, and then all of for $100 with a 3% coupon, and then interest rates go up to 5%, well, that bond isn't worth $100 anymore, the 3% one. You might get $80 for it, and people sell it and take the loss. But they're always holding the bonds almost exclusively to maturity. So, there's going to be ups and downs in the market, but they're playing the long game here. We did have one company of the four we don't deal with as much, they kind of in the last 10 or 15 years went the extreme where they had so much in bonds, like they almost got to 80% fixed income overall. And we saw their dividend really suffer from that. They've since come back to the fold, like the rest of the companies we have here. And then the other one that's kind of neat is the private placements. So you think, oh, great, I can do a private lending. I've talked before, I did a private lending to a developer, undergrad at 15%. Great. Well, think of these big corporations that are doing, these big infrastructure projects, and they need to raise $50, $100 million. Well, they're not going to the general public for this. They're going to the people with big money, which are the insurance companies, which are the major financial institutions. So think of ones like the toll highway in Ontario, the 407, or the Bridge PEI, major infrastructure projects. That's where these private placements are coming in. So really huge opportunity there that individuals aren't going to get for those private placements, and those tend to be higher rate of returns.
Well, yeah, they've got a lot of cash that they're working with, right? Some of these
they collect a lot of premiums.
Yeah, got a lot of cash that they're working with, so they can take on those other investments. Another one on there are mortgages, right? So for inside of these funds, they're typically looking at commercial mortgages. And when you think of those major players that we work with, for example, Manulife, like you hear of them. They are a big commercial lender out there. These are the types of, they've been, I think I looked at one of the stats, like they've been doing mortgages from here since 1887, right? And now they're one of the biggest mortgage providers across the country. So, pretty consistent with their mortgages and that kind of thing. So mortgages would be another big one, an underlying asset. I'd say mostly commercial. I think some of them have a little bit of private, but it's typically the commercial mortgages that you're going to see them invested in.
Yeah. And then when you look at the equities, this is the 18-20% that goes into equities. Think of big, strong Canadian, U.S. international companies, right? Like the banks, the energy companies, the technology, some of the bigger technology companies, telecommunications, blue chip stocks. Again, nothing where it's not super high risk thing. It tends to be safe stocks, long term goal there. So no huge volatility in the stock market portion, and the stock market portion is roughly 1/5 of the overall fund. So even with a little volatility there, the rest of the stuff is not as volatile. So we mitigate that risk.
So the next one we want to talk about is real estate. So this makes up, between 15 to 18% or so of these portfolios. And we work with a lot of real estate investors and for this reason, right? These funds do invest a lot like a real estate investor would be investing. So it's very easy. I feel myself that real estate is very, long-term, conservative. It's always going to be there. Someone always needs a place to live. So they feel the same way inside of this fund. Now, most the bigger funds out there, you're going to see them investing, or, they're going to be those top quality office buildings, commercial spaces, suburban markets, large suburban markets. They're pretty diversified by location and by property. If you look at any of the cities across the country, you're probably going to see one of these big office buildings downtown. You're going to see the insurance companies right down in the middle, and probably one of the oldest buildings in town too, right? For a lot of these. So just a little bit of a breakdown of one of the funds. They've got real estate in Ontario, 56% in Ontario, so big market there. British Columbia, 23%, Alberta, about 9%, Quebec, about 12%. Out of that, you're looking at office space of about 20%. Now, I know people are a little bit leery on the office space side of things, but you have to remember that they're using a lot of this office space. So if you see one of these insurance companies, they're actually one of the biggest employers in Canada, and they need a place for their employees. So you're typically going to pay the rent on your own building, which is cool. They've got real retail at about 16, industrial 45. So big place in industrial, which I think is important. We don't want a lot in commercial, but industrial is a big space. It's not going anywhere. You've got residential at about 11%, and then other at 7% is kind of the breakdown of this fund's real estate, which I think is pretty neat to see, right? When you're digging into it to know where they're investing and where those returns are coming from. We do have one of the companies, they invest a little bit differently, and they're not looking at that industrial and that office space as much. What they're looking at is real estate and mostly strip malls, and it came from from COVID, they decided, why don't we focus on these places that are going to stay, e-commerce proof, right? Nail salons, liquor stores, dry cleaners, things that are going to stay open through this, which is a neat take on it. And I like the fact that we dig into the real estate, because having conversations with clients on where they fit or what they're, it's the same thing. Like if that's the way that you feel, then that might be the right company for you to be using as well when you're looking at their targets and what they're investing in the real estate market.
Yeah, and those strip malls, that's kind of cool, right? That's I was down in Denver at a conference last year, and they talked about mega trends, and that was one of the mega trends of investing. It's like those things are sort of never going away, right? We're always going to have in-store places. You're always going to go to the drugstore, the liquor store, the nail salon, et cetera. Those are never going to go away. So there's a huge uptick in people wanting to invest in those. Now I want to get into policy loans, and then again, there's some companies that have differences. Like we talked about the strip mall stuff, like that. That's Equitable, right? Equitable's kind of, that's their focus in strip malls. When it gets into policy loans, different companies have different interest rates. So the interest rates go from 6.5. Sorry, these are policy loans, 6.5 to 9, or 9 and change. Though some of them are subject to up and down with the interest rate, so they'll come down. But you think of, Christina, you mentioned you liked real estate because, it's actually a hard asset. It's backed by something. Well, think of these policy loans. Like, again, you're thinking of, you own part of this participating whole life fund, and that fund is going to loan people money. And you're like, whoa, you're going to loan people money? Like, I hope they pay it back, because, if not, it's not going to be a good decision to loan money from the fund. Well, if you think of these policy loans, they're loaning it to policy holders, and it's backed really by the death benefit, right? Or the cash value and the death benefit. So we know with 100% certainty, this money's going to be paid back, because everyone's going to die someday. So they're incredible loans, and these loans are earning a rate higher than the dividend rate right now. So this is helping the dividend rate. So you think of $1 billion loaned out in policy loans, well, that's $1 billion earning a healthy rate of return that's higher than the current dividend. It's going to drive the dividend higher, and we know the loans are going to be repaid because it's 100% backed by the policy, dollar for dollar. So huge advantage to the fund for loaning money to policyholders.
So I think the next thing we want to get into is who manages the fund. So with these, we've talked about it before, we're not going in and picking and choosing the investments and where, how much is going to be in real estate versus the other. They do have a large team at each of these insurance companies that does that for us, right? So included, it's the insurance company's responsibility to manage the fund, but they're going to have a lot of people that's working on it for them, right? They've got chief investment officers, they've got investment analysts, they have risk analysts, they have people analyzing asset classes. They've got a large team of individuals. One of the individuals on their team, though, that you're not going to see in a regular portfolio manager's team is an actuary. So they have actuaries on their team because they need to decide, how we got to make sure that we pay these death claims, how much should we be charging for premiums, what the dividend amount should be so that we have those premiums. Like, it's a whole different ballgame with the actuaries included in there. They're a vital role, right? Because they have to make sure they're the insurance part, they're the insurance risk. They have to make sure that they pay all these death claims, that everything works out the way that they want it. So they've got the actuaries on board to do that. Now, something cool as well is that they make these decisions and the insurance companies are going to be, making the call on it. But annually they have a meeting where policyholders can go in and they have votes. They can actually vote on certain things as well. So you will get, if you're a policyholder, you'll get a letter in the mail saying that they're having their annual meeting, and you can be involved in that meeting and make a vote. I don't know if it'll change things dramatically, but if everybody decided to change something, I'm sure they would. But it's neat to see that as a policyholder, you do have a bit of a vote in it. You don't decide on the funds and everything. You've got experts to do that for you, which I like myself. But you are included because you are the owner of this fund in the big picture, right? As the policyholder. So you've got the insurance company managing the funds. So obviously they're going to charge a fee, right? That's typical in any kind of investment fund that you're in. The best part about these is that the fees are incredibly low. So if you're investing in a typical mutual fund in Canada, you're looking at around 2.2% or so as a management expense ratio. Inside of these funds, The fees are federally regulated, so they can't just change these fees overnight. And you're looking at about a 0.1 to 0.18% fee. That's very 2 to 0.1. That's incredible, right? And people will be like, oh, that's too low. But again, you think of it, these are like $20 billion funds, right? That is, there's a fair bit coming off a $20 billion fund at the end of the day. So those fees come out of the overall investment return. So a lot of people ask, where does that fee get paid? Is it coming off my dividend? No, what happens is the fee gets removed from the overall return of the investment returns in that fund. And then when they're looking at what the dividend is for that year, deciding on it, they're going to take that investment return net of fees into consideration when deciding the dividend. So it does impact it, but like not directly, right? When we're looking at those. Plus very, very low, which is nice.
Yeah. I mean, that's 0.1 to 0.18 to 2 to 2.2. Like, that's absolutely mind blowing. And when you look at, we talk a lot about those wealth destroyers, taxes, fees, volatility, and spending. And this is one of the huge wealth destroyers, fees. So participating whole life fees are federally regulated and incredibly low. That's going to mean just more money for you long term. And again, it's only a few of the companies that are regulated with respect to fees. Traditional whole life, the average whole life on the street, they can charge whatever fee they want, change it anytime they want. But for these participating funds, the four that we deal with, they're federally regulated and they're extremely low fees. And we know low fees is going to mean more money long term.
Absolutely.
Another question we get all the time is, are they going to continue to pay dividends, or are dividends going to go up, or dividends going to go down? Or, we saw the last 10 or 15 years, dividends were coming down slightly and people got concerned about that. Well, let's have a conversation about that. So if you think of what the fund was invested in, right? We've got mortgages. People are loaning out mortgages or the company's loaning out mortgages to individuals and companies. Well, what was a mortgage going for 3 years ago? Loaning mortgages at 2.5. That's fairly low number. Well, what a mortgage is going for now? Well, 5, 6, or 7, depending upon when you're listening to this. Those are going up. What about bonds? Are you going to earn more in bonds as interest rates go up, or when interest rates were rock bottom? So what we have is a fairly large portion of this fund invested in interest rate sensitive products, right? And we had incredibly low interest rates for a 15-year period, extended period of time, incredibly low interest rates, and the dividend still never dropped below 6%. So for 3 of the 4 companies that we deal with. So the dividend never dropped below 6% because of all the other things they're doing, and it's not just the investment performance, it's other calculations come into this too. So historically, if you look at the last 30 years, the average dividend for one of the big companies is 7.58. If you look at 60 years, it's 8.73. So think of that, 60 years, 8.73. Those are actual numbers. Those are not projected numbers. So where do we think the dividends are going to settle out? We're not promising anything, but I mean, most people in the actuaries and stuff you talk about say, we don't see dividends going down anytime soon because interest rates aren't expected to go back down to rock bottom. So we saw the sort of flat note at 6, and now we see them increasing each year as interest rates go up. And that's going to be an ongoing process, because if you think of all the new money that came in this year, well, that money is going to be reinvested at a higher interest rate than money was 3 years ago. Or the 5-year mortgage that came due today that they were getting 2.5%, and now they're putting that mortgage back out at a renewal at 5 or 6 or 7%. Well, that means the return of the fund is going to go higher. So typically when interest rates go up, and we've got like a 150-year plus track record of this, when interest rates go up, the dividend will follow, but there's a bit of a lag, right? So we saw interest rates spike. Now we're seeing dividends creep up, but I think we're going to see continue that. I mean, long term, a lot of people think, put on that 7.5%, more like the historical 30, 40-year return we've had. But I think right now is probably one of the greatest times in my lifetime to purchase whole life, because we're coming out of a low interest rate environment and we're going up, and no one expects it to settle back down to where we were. So if it settles, even down a point from where it is now, the long-term expectations are the dividend will continue to increase and then level out, hopefully over that 7% number. So it is literally, I think, the greatest time to purchase a participating whole life. And remember, when we get those dividends, they're ours for life. If we've got 100,000 and next year we've got 106,000, we can't drop down below that 106 like you can in the stock market or any other real estate. Once you have that dividend, it's yours to keep, guaranteed not to drop, guaranteed to go up. And again, incredible track record of these dividends going back to 1867.
Yeah, no, I tend to agree with you, Darren. We do get the question when you're looking at the historical dividend scale and seeing it kind of come down from the 80s, which you hit on exactly there. Why it did what it did when we came down. Looking back, do I think that we're going to be at a 10% dividend in the next couple of years? I personally don't think that we're getting back to that place because the 80s weren't normal, right? It just wasn't a normal time when we looked at interest rates. But as well, it wasn't normal when we had 2% mortgages either, right? That wasn't normal either. So looking at, the historical average and kind of balancing that out, I feel really comfortable looking at where we are for current dividends because we're in that 6 to 7% range. Where myself personally, I think it's going to fall. And you have to remember too, that it doesn't move quickly. It moves like a turtle. So even if we are on our way back up, you're going to see it move by like a couple points per year. Like we're not going very quickly, just like it didn't go very quickly back down, right? Like when it came down from the 80s, it moved very slowly. We seen it, over 30 years. So we're probably going to see it go back very slowly. But I don't think we're ever getting back to those dividend. I don't know. Correct me if I'm wrong. 10, 20 years from now, I'd love to hear that. But I do think that will settle out around that 6 to 7. So when you're looking at your illustrations on your policies and you're looking at current dividend and you're comfortable with that, or you're looking at a -1 and you're comfortable with that, well, you're set. Like I can't see this. We went through the Great Depression and it didn't hit 5%. Like, come on, guys. I can't see it happening. Anyways, that's my 2 cents on it. And so I just want to throw that in.
Yeah, I mean, logically makes sense. Why was the dividend 10% in the 80s? Well, look what interest rates were. Think of the mortgages and the bonds they were able to buy then versus the last 15 years, right?
Well, it's spread over 5-10 years too, right? Like that's why it's so slow. When we looked at those bonds, they're buying them in 5+ year periods. It's not a 1-year bond that they're renewing each year. It's going to lag.
Yeah. And not only, are we going to get that probably 7% dividend in change long term, but remember, we're talking about and assets, right? This is just where we're storing the capital. We're not trying to get the greatest rate of return in here. We're trying to store capital, store our money in a safe, bulletproof spot, and then multiply that money and do that and asset where we're leveraging that money and then putting it into something else and providing a death benefit. So, I would be ecstatic if the dividend stays where it is, and I think it's going to increase over the next few years, even better. So I just think there's really not a better place to store or save your wealth. And the timing, I think right now is just perfect to start loading up on these cash value life insurance policies because the dividends should be on the way up. All right. Thanks for watching. Thanks for listening. Have a great day.
Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.